Okay, let's unpack this. Have you been watching the Indian markets lately? Maybe Nifty, Sensex, and feeling like the volatility's kind of picked up, maybe acting a bit. Well, like Bitcoin used to feel a few years back, big, fast swings. And now it feels like the conversation's shifting a bit. You're hearing more buzz about trading options, but in crypto itself. Maybe the roles have sort of reversed in terms of where the perceived action is. Today we're doing a deep dive. We've got some fascinating material here that tackles this exact shift, comparing options trading in, familiar Indian markets like Nifty against the dynamic world of crypto options. We'll look at platforms like Delta Exchange based on the info we have. So our mission, let's try to cut through the noise, pull out the important stuff from this material, understand the real differences, costs, potential returns, the risks, the real risks you need to know, and how the rules compare. What's the actual story here? Let's dive in.
Okay, so starting with the Indian market side, our baseline, really. The material confirms what I think many traders have felt, more volatility recently in Nifty, Sensex. And it also mentions changes in lot sizes. That's pretty significant because, well, it directly hits your capital requirement, right, for certain strategies.
Okay. And the examples in the material really drive that home. Like if you just want to buy an option, say a Nifty call at the money, might cost you around, 6,000 euro for one lot? Which, feels pretty accessible for someone starting out, maybe. But then, and this is where it gets really interesting, a major point here, if you want to sell options in the Indian market, whoa, the capital needed just jumps massively. Selling just one lot could need, 1.5 lakh, even up to 2 lakh, just for the margin.
Exactly. And that figure, that huge capital requirement just to sell options, that's a major barrier for a lot of individual traders in India. It basically locks people out of certain strategies like income generation through selling premium, unless they have pretty deep pockets. It's a really key structural difference to start with.
Okay, so that's kind of the lay of the land in India. Now, let's pivot to the crypto options world. We're talking Bitcoin options, Ethereum, Solana, these kinds of assets.
Yeah, the first question that always pops up, especially for folks in India, is, hold on, is this actually legal? And the info we're looking at is quite clear on this. Crypto itself, it wasn't banned permanently. The Supreme Court ruling lifted that temporary ban. The really crucial detail, though, that the material highlights is using platforms registered with the FIU, India's Financial Intelligence Unit.
FIU registration. Why is that so important?
Well, because these FIU-registered platforms, they let you trade in Indian rupees, INR. You're not forced to use USD or crypto itself as your base trading capital.
Ah, okay. Trading in INR.
Right. And because you're trading in INR on an FIU-registered platform, it means that 30% tax, the one on speculative crypto gains, when you trade crypto to crypto or cash out, it doesn't apply to these trades. So, according to this analysis, using an FIU platform, trading in INR, it's totally legal.
That's clear then. And looking at the platform visuals shown, honestly, it looks pretty familiar. The charts feel like TradingView. And the options table layout, calls on the left, puts on the right, very much like an NSE option chain. So it doesn't look alien, Different assets, but a familiar environment. Okay, let's get back to capital, because this is where crypto options really seem to diverge from the Indian market setup, especially for sellers.
Totally different picture.
The data here suggests you can start selling crypto options with way less capital. Like the entry point can be incredibly low. You want to start with 100 euro, 1,000 euro, 1 lakh. It seems like the choice is yours. It just depends on the quantity you trade, because one contract unit is often just like $1.
Yeah.
So that ability to sell options with small capital, that's a massive difference from needing lakhs in Nifty. It's going to be a huge draw for people.
Absolutely. And another difference highlighted is the expiry choices. In crypto options, you've got daily expiries, weekly, monthly, even next month.
Daily expiries. Wow.
Yeah. So having those daily and weekly cycles just means more frequent chances to trade, potentially capture that time decay, compared to mostly weekly and monthly in traditional markets.
Okay. More opportunities. But let's talk premiums. This really jumped out from the material. The comparison between Nifty and Bitcoin straddle premiums, it's quite something. Just to clarify, a straddle premium is roughly the cost of buying both a call and a put at the same price. Gives you a sense of the market's expected move priced in.
Exactly. The implied volatility baked in.
And the numbers shown, they're pretty stark. Nifty straddle premium might be, around 3% of the index value?
About that, yeah.
But Bitcoin, the example shows its straddle premium at around 8%, even with only 4 days left its expiry in that example.
Yeah, it's a huge gap. That's like 2.5 times higher premium on Bitcoin compared to Nifty in that specific snapshot.
2.5 times.
And what that implies, well, for option sellers, that higher premium means there's potentially a lot more decay value to capture. Assuming, of course, Bitcoin doesn't make a massive move against you. The source even had a chart suggesting Bitcoin straddle prices decayed somewhat linearly, which is, very appealing if you're selling premium.
Right. So higher premium, more decay potential. And we already said lower capital needed to sell. So let's connect those dots. What does the potential return look like? The material gives this example. Selling a Nifty monthly straddle might need 1.5 lakh capital. Potential profit shown, around $55,000. If the market stays flat, that's roughly a 28% ROI. Not bad.
Pretty decent, yeah.
But then look at crypto. The example uses about $3,000 capital. That's roughly 2.5 lakhs, so a bit more capital than the Nifty example, actually. But the potential profit shown for that Bitcoin strategy, around $12,000.
Okay, now hold on. Let's compare the percentages there. In the Nifty example, it was about 28% ROI. In the Bitcoin example, 12K profit on 3K capital. That's like 400% potential ROI.
400%? I mean, that immediately makes you ask, how on earth is that possible?
Yeah, that number jumps out.
And the material gives a clear answer. Leverage.
Yep.
That potential for such incredibly high ROI and the ability to sell with low starting capital, it's mostly down to the high leverage available on these crypto platforms. And the example mentioned 100x leverage.
Exactly. Leverage multiplies your exposure based on a smaller margin deposit. So potential gains look huge relative to your initial capital.
Right. There's always a but, right?
Always. And it's absolutely critical. We have to balance that potential, that allure, with the significant downsides the material also flags.
Yeah.
High potential always comes with high risk.
Okay, so what are the big ones?
Well, one key issue mentioned is liquidity, or sometimes the lack of it. The material points to the bid-ask spread in the crypto options table. That's the difference between the highest price someone's willing to pay, bid, and the lowest price someone's willing to sell at, ask. And that might be different from the mark price you see, which is more like a theoretical midpoint.
Right, the spread. And why does that matter so much?
Because that spread is basically a trading cost. It can eat into your profits, especially if you're doing complex strategies with multiple legs, or if you need to get in or out fast. You might not get filled at the price you expect. Your execution might be worse than the theoretical price suggests.
Okay, so liquidity is one. What about fees? People often think crypto fees are really high.
Yeah, that's a common perception. The material clarifies this a bit. Options fees are typically calculated as a percentage of the notional value.
Notional value, right. That's the contract size times the price of Bitcoin or whatever the asset is.
Exactly. It's the total value of the position you're controlling, not just the margin you put down.
Ah, okay. I see where this is going.
So when you use high leverage, say 100x, your notional value is massive compared to your small margin. So even if the fee percentage is small, applying it to that huge notional value makes the fee in dollar terms look bigger. The example showed like a $1, $3 fee on maybe a $100 margin because the underlying position controlled was much larger.
Whereas with lower leverage...
Right. Lower leverage means smaller notional value. So the same fee percentage results in a smaller dollar fee. Like $1.11 find a $10 margin in another example. Okay. So the fee structure might not be wildly different, but leverage definitely makes the dollar cost seem higher.
Okay, so fees are amplified by leverage.
And that brings us back to leverage itself. It's not just about potential returns and amplified fees. It's fundamentally about risk. High leverage means your liquidation price. The point where the platform automatically closes your position to prevent further losses is much, much closer to the current market price.
So a small move against you.
A small, quick, adverse move can completely wipe out your margin. Poof, gone. Automatically liquidated. That's the dangerous flip side of that multiplied potential gain. Much higher risk of getting knocked out.
Okay, so high potential, but definitely some serious risks to manage. Does the material offer any advice on how to actually trade these things, considering the risks?
It does offer some practical points, especially around managing that leverage risk. One suggestion is switching the margin mode on the platform. Moving from isolated mode, where only the margin for that specific position is at risk, to portfolio mode. This is especially useful for spreads or strategies with both long and short legs.
Portfolio mode. How does that help?
Well, it allows the platform to look at your whole portfolio, or at least the related legs of a strategy. It can use the profit from one leg to offset the loss on another when calculating your overall margin requirement. This can give you a bit more breathing room against liquidation and helps define your maximum loss and profit for the combined strategy more clearly.
Right, so it looks at the net risk of the strategy. That makes sense. And the material also showed you can use familiar strategies, right? Like a bear call spread.
Absolutely. All the standard options strategies can generally be applied.
And revisiting that bear call spread example, it showed the crypto version needed much lower capital, around $400, for a potential percentage return of 31%, compared to the Nifty equivalent example, which needed about 77,000 capital for a 17% potential return.
Yeah, again, highlighting that capital efficiency and potential ROI difference enabled by leverage. So the core strategic toolkit is the same. You can buy options if you expect a big move, sell premium if you expect things to be calmer or sideways. It's just applied in a different market context with these unique mechanics around capital, leverage, and liquidity.
Okay, right. After we wrap this up then, let's unpack the main takeaways from this deep dive. What we've seen from the material is pretty clear. Crypto options, like on Delta Exchange, seem to offer, well, potentially much higher ROI in some examples, and definitely require significantly less capital to get started with selling strategies compared to Indian markets like Nifty.
Yeah, that's largely driven by those higher premiums we talked about and the availability of significant leverage.
However, and it's a big however.
A very big however. That potential comes wrapped in some serious caveats. The material clearly points out potential liquidity issues, those bid-ask spreads that can impact your fills. Fees that, while maybe similar percentage-wise, feel much larger in dollar terms because they're based on that highly leveraged notional value. And most critically, the significantly increased risk of liquidation that comes packaged with high leverage. Get the direction wrong even by a bit, and you could be out fast.
So ultimately, it seems both markets offer opportunities. The material isn't saying one is definitively better.
No, not at all. It's about understanding the fundamental differences. Different structures for capital needs, different premium levels, very different risk profiles, especially around leverage and liquidity in crypto.
Knowing these differences seems to be the absolute key takeaway. Manage the unique risks if you step into that crypto option space. Maybe use tools like portfolio mode to help define that risk.
Precisely.
Okay. This exploration of the material has definitely given us, and hopefully you, a lot to chew on. The dynamics are quite different.
Yeah, what's really fascinating is seeing how the same basic options trading principles apply. But the mechanics, the capital involved, the risk-reward equation, it just shifts so dramatically between a traditional index like Nifty and a global 24/7 crypto asset like Bitcoin, especially with that leverage factor.
So, based on everything we've unpacked here, drawing from this source material, here's maybe a final thought for you, the listener, to consider. Given these really stark differences, we've seen the potential returns, the low capital for selling, but also the amplified risks like liquidation and liquidity in crypto options compared to Nifty. How do you personally weigh that unique risk-reward profile? Does the potential upside justify the increased danger? And thinking specifically about Bitcoin, as the source is focused on it, where do you think Bitcoin's price might realistically go this year? And how would that view shape the way you might approach the opportunities and manage the risks that we've talked about in these markets? What really stands out to you from this comparison? Something to mull over.